The accounting equation is really useful when we're processing the transactions of the business. So let's just quickly recap what it is. It's two ways. The accounting equation can be expressed in two ways. There's also a third way if you want to be fancy, but we said, look, primarily the two ways that we're going to need to know are assets equals liabilities plus owner's equity. So that's technically the accounting equation is this. But we can rearrange it into this second way, which is owner's equity equals assets minus liabilities. But I guess mathematically you might need to be aware, it's very unlikely it will come up in our course, but you could rearrange it again and say liabilities equals assets minus owner's equity. But we'll focus on these top two ones for the most part. And just for the rest of this video, we'll just look at this first expression of the accounting equation here. So what are we talking about? We're saying it must always balance for every single transaction. For example, you decide to buy a house worth $900,000. You have $200,000 in the bank, which you put towards it, but you're going to borrow the remaining $700,000. So looking at the accounting equation, the first way, we've got a $900,000 asset equals your liabilities of $700,000 plus your owner's equity of $200,000. If you put $200,000 into buying that house, that is your equity part of it. Now, what about the second way? We can say, well, the $200,000 of equity equals your $900,000 house minus the $700,000 loan against the house, and both balance. But what's more important is that it also must balance not just for a single transaction, but also for an entire business. So let's say we've got a hairdressing salon business with these assets. It's got a $200,000 property, $40,000 of equipment. It's got $10,000 of combs and hair product and things like that, and $50,000 on the bank in the bank. But it also has a $100,000 loan to the Bendigo Bank. So we can express it these two ways, the accounting equation. Now, if we add all this up, we've got 200, 40, 10, and 50. That's $300,000 of assets equals liabilities here for $100,000. So that must mean in this case, the owner's equity is $200,000. Now you can express that the second way. We can say the $200,000 of equity equals all of the assets, $300,000, minus the liabilities against those assets, which is $100,000. It's also going to be true and help us direct when we're doing each transaction. So after every transaction, the accounting equation will change. And most importantly, it's got to balance. If it doesn't balance, there's something wrong. So let's take a few examples. Let's say on the 1st of January, Harry Hampson decides to set up his own business called Harry's Hats. He deposits $50,000 of his own money into a bank account in the name of Harry's Hats. That is called a capital contribution. What we know our entity principle, our accounting assumption, says that Harry and the business are separate entities. Harry's now given his own personal money to the business. That's called a capital contribution. So with our accounting equation, assets must equal liabilities plus owner's equity. So from the business's perspective, it's now got $50,000 of cash. Cash is an asset. And it's now got $50,000 of capital, which is increased owner's equity. So we've got assets have gone up 50 equals liabilities of 0 plus owner's equity of 50. So together, 0 plus 50,000 equals 50,000. That balances. All right, on the 2nd of January, the business spent $10,000 cash to buy inventory or stock of hats. Here's our accounting equation. Now, on the one hand, one asset called cash has gone down 10,000. However, what did we get for our money? Well, the business went and spent that money and it bought inventory, which is another type of asset, and that went up 10,000. So all that's happened here is one asset's gone up and down by the same amount, so that balances at 0, equals liabilities of 0 plus owner's equity of 0, and it looks like nothing's happened. If these numbers are all 0, did this transaction even occur? It did, because 0 is a number. We just said the accounting equation has to balance after every transaction. Well, to balance it the numbers need to add up. Well, these are numbers. That's fine. Something did happen and it does balance, so that's okay. On the 3rd of January, the business borrowed $20,000 from XYZ Bank. Here's our accounting equation. What's it got more of? It's got more money. Money is an asset called cash, and that's gone up $20,000. However, that has come with an obligation. That is what we call a liability, and that obligation is the loan to repay to XYZ Bank. And that's our accounting equation. Assets have gone up 20,000 equals liabilities up 20,000. Nothing happened here with owner's equity. So together, 20,000 plus 0 equals 20,000. On the 4th of January, Harry took out $10,000 from the business for his personal use. He's allowed to do that. We just say it's not a business expense though. It's the business giving or Harry taking out his drawings, his capital which we call drawings. He's allowed to do that. And our accounting equation changes. First of all, from the business's perspective, not Harry's, from the business's perspective, it's got less money. It lost $10,000 today. Okay, what did it get? Did it get an asset with it, like inventory or something? No. What happened was Harry, the owner, withdrew his capital. So capital goes down, and that's owner's equity. We've got assets down 10,000 equals liabilities of 0 plus owner's equity of down 10,000. That balances. And let's just take another example. The business repaid $5,000 of the loan owing to XYZ Bank. What does that mean? Well, let's look at the accounting equation here. We've got less money. We spent $5,000. So that's an asset called cash decreasing, equals your liabilities. But in this case, what we're saying is the liability called the loan to the bank has gone down. Okay, originally we borrowed, I think it was $20,000. Now we only owe them $15,000. The liability has decreased. So in this case, we've got assets decreasing 5,000 equals liabilities also decreasing 5,000 plus 0 on owner's equity. And together that balances. And so the good thing about the accounting equation is that you've just been doing it for one transaction at a time, but without realizing it, you're kind of doing it for a whole business. And it's balancing for that entire business every time, and it's changing after each transaction. So we had the first transaction here, capital contribution 50,000. That was this. Cash went up, 0 plus this. And then, so we said the accounting equation is $50,000 equals liabilities of 0 plus $50,000 of owner's equity. Then it changed. Spent $10,000 to buy inventory, and all that happened there was one asset called cash went down, one asset went up. So what happened up here? Well, this actually stayed the same. That stayed the same, and that stayed the same. Then, on the third, we borrowed $20,000 from XYZ Bank. The effect was cash went up, so did liabilities though. So this went from 50, so it's gone up another 20. That went to 70. This went to 20, and that stayed at 50. 20 plus 50 equals 70. Beautiful. Then on the fourth, the owner withdrew $1,000 for personal use. Cash went down, so did equity. So this went from 70 to 60. This didn't change, and this went from 50,000 down to 40,000. Beautiful, it balances. 20,000 plus 40,000 is 60,000. And lastly, the business repaid the loan to the bank. We can say that we owe $20,000 to the bank. Well, we don't now, because we spent $5,000 cash to reduce that loan here. So this went from 60 down 5 is 55. This went from 20 down 5 to 15. This stayed at 40, and together 15,000 plus 40,000 equals 55,000. So the point is, the accounting equation is not a static thing. It's changing every time there's a transaction here. We've got to figure out the effect for the individual transaction, but then we've got to update the overall accounting equation for the entire business, and that must also balance every time.